We've been through most of the steps now to do the valuation of tricky lawyers. We've forecast out the free cash flow at the firm. We've calculated a weighted average cost of capital. That's allowed us to calculate the terminal value using a growth perpetuity calculation. We've also estimated the WACC. That's allowed us to do the discounting of those cash flows back down to a present value. And we've got those present values nicely set out in our calculation here. So we have cash flows year 1, year 2, year 3, year 4, all expressed in present value terms. Our year 5 cash flow is a mixture of two items here. It is the present value of that 35,238 we generated in year 5, but also it's the present value of the terminal value, all of those cash flows expressed year 6 till infinity, discounted back down to year 5 terms. What we then had to do is discount both of those sets of cash flows back down to a present value. So we've actually we've effectively discounted the terminal value twice, back from infinity to year 5 back to year 0. So there's been a two-step set of discounting there. Now what we're now going to do is look at the valuation of the company. Now the valuation of the company, the first thing that we're going to do is we're going to work out the enterprise value. And the enterprise value, very simply for a DCF, and I'll tell you what I'm going to do, make this a little bit neater. So I'm just going to move that one period across and essentially express that the enterprise value is the sum of the future cash flows discounted back by a weighted average cost of capital. These future cash flows at the free cash flow at the firm level belong to debt, equity and minority interests. They've been discounted with a cost of capital that's reflected the cost of debt, the cost of equity. Cost of equity is trying to reflect both the minority interest and the equity shareholders of the business. We've taken that discounted, worked out the present value, and if we were to value what the cash flows are worth to these parties in their hands today, given today's risk, the value of that business would be £488,747. Sounds very, very precise. What we do, or what we are aware of, is DCF has some very sensitive assumptions in there, both in the WACC as well as in these free cash flow to firm estimates. Now, enterprise value, whilst it is useful from let's say an M&A perspective to say what would it cost us to buy out the entire business, well, the value to the existing shareholders, the minority interests, and the fact that we need to refinance part of maybe all of the debt, well, that would be captured by the enterprise value. But ultimately, if we're in discussions with shareholders, what we are certainly interested in is an equity value. Now what we're going to do is we're going to get down to an equity value by just taking out from that enterprise value number stuff that doesn't belong to the equity holders or the equity value investors. Easy things that don't belong to them. Well, if I'm an equity investor, I do not own net debt. If I'm an equity investor, I do not own the non-controlling interest. Now in this question, what we did do is we gave you these two bits of information. So I'm going to grab them, I'm going to pop them into my breakdown here, and then I'm going to emphasize that they do not belong to me. If they do not belong to me as an equity holder, I've got to strip them out of my estimation of equity value. Now there is one more element for us to focus on. What I have to do is I have to add back in the investments in JVs and associates. Now let's put the add back in at the moment, and then what we can do is we can talk about what the reason is for this add back of that number. Now the only reason we are adding back the JVs and associates is because they are excluded from that enterprise value calculation. Now if they're excluded from that enterprise value calculation, they can form no part of the free cash flow to firm calculation. So for some reason, when we are looking at JVs and associates, the value of their cash flows do not enter any of these numbers that we have in the DCF. And the reason for this is purely accounting. JVs and associates, for the most part, 99 times out of 100, will be accounted for using the equity method. And what the equity method suggests is that when you come to account for a joint venture or an associate, all you do not consolidate, you do not add their value in line by line as you would do with a subsidiary. What you do with a joint venture and associate is you account purely for the ownership. If you own 40% of another business, let's say it's an associate, what you would bring in is 40% of their net income. But most importantly is that 40% is normally brought in below the EBIT line. And if it's below the EBIT line, what that means is your EBIT number does not capture the value of joint ventures and associates. Therefore, your EBITDA doesn't capture the value of joint ventures and associates. Because these joint ventures and associates are equity accounted, i.e. in one single line we take in the proportion that we own, they're not consolidated. And if they're not consolidated, D&A is just parent and subsidiaries. Working capital is just parent and subsidiaries. CapEx, tax is just parent and subsidiaries. The free cash flow at the firm line does not capture that value that is in the JVs and associates. As a result, what we have to do in order to get back to an equity value that reflects the fact that we might have very good joint ventures and associates is that we have to add these numbers back in. So to get to equity value, I take out net debt, I take out minority interest, I add back JVs and associates, and I'll get to an equity value of 402,179. Now the issue is, where do you get this information from? Well, in an ideal world, it would be the net debt today at market value. It would be the non-controlling interest today at market value. Likewise for the JVs and associates, market value number as of today. Now, just practicalities, this might be very difficult information to get a hold on, especially if you're looking at a pitch situation as opposed to an execution situation. Now, in terms of trying to get good, quick numbers, the idea would be is, again, fair value, perfect, the best numbers that we can get. But what you're looking at here is the latest available information. Now, again, you've got to work out how much time it's worth spending getting better numbers. If you have a relatively small JV and associate number, pick up the balance sheet, latest available balance sheet, pick up the book value. However, if the book value is deemed to be materially out of line with the market value and the JV and associate number is big enough to warrant doing this additional work, you would have to value those JVs and associates. Great example of this is when Carlsberg and Heineken took over Scottish Newcastle Breweries. Scottish Newcastle Breweries had a big joint venture with a company called Baltic Beverage Holdings. And the size of this number, it was getting on for about half of the enterprise value overall. It was a significant figure. As a result, what you shouldn't do, and what they didn't do when they did the valuation of this company, they didn't take the balance sheet number, the book value on the face of the balance sheet. They went back and they valued Baltic Beverage Holding in detail, DCF, trading comps, the whole works, came with a valuation at the equity level, and then when it came to this part of the calculation to estimate the value of Scottish Newcastle Breweries, they took 40%, actually it was 50% of this entire Baltic Beverage Holdings figure just to slot into one cell to get to the ultimate valuation. So sometimes you've got to do a significant amount of work to work on this breakdown to get to an equity value figure. Once we've done that, what we're going to do is we're going to divide it by a NOSH figure. Now the NOSH figure we have in the question, 117,460. I'm going to pop that into my little calculation here, and then what I'm going to do is calculate an equity value per share, and I'm just going to divide one figure by the other. So 402,179 divided by the NOSH. I'm then going to express that to 2 decimal places, and we have a little star for that, and I get a number there of 342 per share. Again, sounds very precise. We would run sensitivity analysis on a number of inputs in this calculation to give us an idea of where that simulation could arrive at. But one thing that we can do is we can justify where our assumptions have come from. We have had to think about every single line in that calculation. We've had to think about the terminal value. We've had to think about the risks of that business. We've had to think about the growth rates. And all of that thought process, all of that information is captured in that breakdown to an equity value per share. And that is the nature of a DCF. It gets you to think about the business, know what's going on, try and capture that information into a framework which we can justify where the value has come from. It may not be right, but we've certainly got a simulation of an outcome there. Now, further videos we will have a look at. We'll look at a series of videos of when DCFs go wrong, typical errors that are made on a DCF. We'll look at more complication to do with mid-year discounting versus end-of-year discounting. How do you benchmark your DCF? Very, very important stuff that you'll see in some of the videos that we have in this section.